So you're just starting to learn about investments, and all you keep hearing about is buy ETFs, create a three-fund ETF portfolio, and you aren't really sure what an ETF is. Well, you're in the right place. We are just going to jump right into it. ETF literally stands for Exchange Traded Fund. This is the first and last time you will ever hear it. Other people only use the abbreviation, and so should you. So, what is an ETF? An ETF is basically a single investment that holds a whole basket of other investments inside it. Think stocks, bonds, sometimes things like gold or oil. In this video, you are going to learn all kinds of good stuff. You'll learn how an ETF works, why so many investors use them, how they stack up against mutual funds and individual stocks, and lastly, the most common types of ETFs out there. If you like this so far, make sure to like and subscribe. It really helps the channel out a lot. Now let's get into it. All right, first up, let's talk about how an ETF actually works. An ETF pools money from a bunch of investors and buys all of those securities on your behalf in certain percentages. Let's picture that basket from slide 2 again. Instead of you going out and buying 20 or 30 different companies, you buy one share of that ETF, aka the basket, and you own a tiny slice of everything inside of that basket. And here's the part people really enjoy. You can buy and sell those shares right on the stock market all day long, just like you would with a regular stock. The price moves up and down throughout the day based on supply and demand. Now, most ETFs aren't trying to beat the market with some genius stock picker at the wheel. Instead, they simply track an index. The most famous example is the S&P 500, which follows around 500 of the largest companies in the United States. The ETF just mirrors that list. I'm sure you've heard of VOO, SPY, or IVV. That is just where most people should start their investment journey. Next, let's get into why people actually love these things, because there are a few advantages. The big one is instant diversification. With a single share, you're not betting everything on one company. You are spreading your risk across dozens or even hundreds of businesses at once. So if one company has a rough week or year, such as Lululemon here in 2026, it barely moves the needle. The second benefit is cost. ETFs usually have very low management fees called expense ratios, especially compared to actively managed mutual funds where you're paying a professional to run the show. A typical low-cost index ETF might charge something like 0.03% per year, which is tiny. Third, there's tax efficiency. Because of the way ETFs are built and traded behind the scenes, they usually trigger fewer capital gains taxes than mutual funds, which means more of that money stays invested. And finally, there's basically no minimum to get started. You can begin with the price of a single share, and even some brokerages now let you buy fractional shares. So you could start with just a few dollars. Now, just real quick, I've spent my career managing money professionally. Now I'm showing my real portfolio, every ETF, with monthly allocation updates only to my Patreon members. If you're serious about this, that's where you need to be. Link is in the description and pinned comment. Now let's compare ETFs to the two things people always confuse them with: mutual funds and individual stocks. An ETF trades all day long, just like a stock. A mutual fund only prices once per day after the market closes, so you can't react directly in the moment. Individual stocks also trade all day, but here's where they differ on risk. An ETF and a mutual fund give you high diversification because they hold many assets, while a single stock gives you none. You're fully exposed to one company. On management style, most ETFs are passive and simply track an index. Mutual funds are often actively managed by a professional, and an individual stock isn't managed at all. It's just you and that one company. And on fees, ETFs are generally very low. Mutual funds can run higher and sometimes tack on sales charges called loads. And individual stocks have no ongoing fee, but obviously zero diversification. So if you want the diversification of a fund with the flexibility of a stock, the ETF sits right in that sweet spot. Next, let's cover the common types of ETFs, because they're not all the same, and knowing the categories helps you pick what fits you. First, you've got stock or equity ETFs. These track indexes, specific sectors like technology or healthcare, or certain company sizes. Then there are bond ETFs, sometimes called fixed income ETFs, which hold government, corporate, or municipal bonds and are generally used for steadier income. After that, commodity ETFs. These track the price of physical stuff like gold, oil, or agricultural goods. So you can get exposure to those without storing a bar of gold in your closet. And finally, international ETFs. These give you access to markets outside your home country, whether that's emerging economies or one specific country you want to invest in. So whatever you're trying to do, there's usually an ETF built for it. So that's the whole picture. An ETF is a basket of investments you can buy in a single share. It's diversified, usually low cost, tax friendly, and it trades all day like a stock. It's one of the simplest ways for a regular person to get started investing. And if you want to see how I am using ETFs in my portfolio, you can check out this video right here, and I'll see you in the next one.